So good afternoon, everyone. Once again, thank you for joining in the afternoon. The topic that we are going to discuss today is the hot topic in UAE for the moment, and I'm sure we're going to add value to your understanding of the corporate tax. So today we have, along with me, my name is Balaram. I'm the managing partner of Spectrum Auditing and Accounting. We have our office in Karama in Dubai, and we are in the business for the last 7 years. We do provide accounting, auditing, and taxation services. So along with me, I have other co-speakers. Mr. Hanmant Kumar, he is a chartered accountant again, and he has got more than 30 years of experience. He served in various industries at various levels, as well as he also into practice. And he established his own firm also for he's been running it for the last 10 years, 10 to 12 years. Recently moved out to approach his own passion. And he specializes in corporate taxes as well as international taxation. And his passion is to look at the international transaction arrangements. That's what he is passionate about. So that's where he's again started his consultancy in corporate tax as well as transfer pricing specific. And I have Manish Sharaf. He's also a chartered accountant. He has got more than 20 years of experience. He has worked with in various levels of various firms. He also worked with big firms like Deloitte and PwC. And Pratiksha is also another presenter. So she is working with Spectrum Auditing for last 1.5 year, 1 year. And yeah, she's got 4 years of experience. So this is the team that we're going to listen from. Let me just, so this is what it is. So before we begin anything, let me just clearly tell you that we are going to discuss this session purely based on the decree law that is released by the Ministry of Finance recently in December. And there are certain frequently asked questions, FAQs, that are again released by Ministry of Finance on corporate taxes. So this is the primary source for us. And that's not the full law as such. We are expecting more cabinet decisions or executive regulations to come in. And combining them will become the full-fledged law to be implemented. And so whatever we are discussing is going to be the skeleton, I can say, that the other part of the body should be released by the FTA, so to say. So anyone who is considering to take any decisions, I advise you to look at this as well as wait for the further regulations to be released, then upon which you can take a decision. That will become the proper one or appropriate one to take to go ahead. So that this being the background, let me just get into the topics that we are going to discuss today. So as I mentioned, so we'll be talking about in the corporate taxes, the background, and then the scope of corporate taxes in UAE, as well as who are the persons that will be considered as taxable persons and what is the tax base going to be. And which entities will be called as qualifying free zones, the benefits of the qualifying free zones, what are the reliefs given in and around the tax laws, and how to form a tax group and what are the benefits of tax group, and what are the rules with respect to withholding tax and foreign tax credit, as well as the related parties and connected persons, the transactions dealt with them, how to deal, and what are the adjustments to be done in the books of accounts with respect to those transactions. In relation to them, we also need to look at the transfer pricing methods, transfer pricing documentation that is expected. This is a very wider topic, transfer pricing and all. So here we will be only touch basing upon it, which is relevant for you to understand the basics. And we are planning to come up with more detailed session on this transfer pricing, related party transactions and connected persons transactions at a later date. And of course, we'll keep you updated about that. And finally, we look at the corporate tax administration in terms of written filing, registrations, records keeping, and what all to be considered. We are planning to have some time for the question and answer sessions if time permits. I request you to hold till then. But if you have any question in between, you are welcome to drop that in the message in the chat box. And we will try to address them either while going through the sessions or at the end of the session. So let's quickly look at why the corporate tax have come into picture in UAE. What are the issues that are generally been there in the country and around the globe? So the by default rules of the taxation in any country generally is that the country or the governments can levy the taxes on the businesses that are generally being generated by those businesses in that country when they have an office or business located in that physically in that country. So that's been the rules framed around, and that's been the practice that has been followed. But as a business form has been evolved, a lot of the businesses, because of this globalization and because of the digitization, the business structure or the way the business is being conducted is been evolving. So the old method of taxing the businesses only when they have physical presence in the country is becoming a challenge. So by taking this as advantage, most of the multinational entities, what they were trying to do is they were coming up with the corporate tax plan in such a way that the tax to be paid in the countries where they have business or the real business being conducted is being actually shifted, or the profits being shifted to some other countries where there is very less tax or where there is no tax at all. So these were the loopholes that countries or governments have been finding issues with, where the businesses were trying to shift their profits from a country where they actually have business to a country where they do not have business, but the taxes are being less or there were no taxes. So in order to address that, just to add one more point, see the tax that has been actually evaded or not being paid is roughly estimated to be 100 to 240 billion dollars yearly. So that's almost like 4 to 10% of the global corporate tax revenues that were being generated by various governments. So in order to address this, the developed nations as well as European Union, they came together and they formed an organization called Organization for Economic Cooperation and Development, which is also called as OECD. So the primary objective of this OECD is to come up with the issues that are presently being there with respect to this particular tax evasion or shifting of the profits from one place to another in order to reduce the taxes, and also come up with the suggestions. So identify the issues and then come up with the suggestions. So that's what been their primary objective. So they did a lot of studies by looking at the business structures and transactions and arrangements that have been made by the government or the businesses. And they have identified various issues around them. They've also came up with the suggestions. They're called as BEPS action plans or plans or considered BEPS action plans. So as I mentioned, the businesses, they were trying to erase the base of the particular profit that they've earned, and they're trying to shift the profit to another place. So erase the base and then shift the profits to another country where the taxes are being less or no taxes. So the way they were doing is through transfer mispricing or by taking the advantage of double taxation avoidance agreements laws that may be legitimate. Treaty shopping. So wherever you have the treaties which are favorable to countries, so favorable to the business, that's what they were trying to utilize and then shift the profits. Or inflating the invoices. So when they have companies or branches in various countries, so they were doing transactions between these companies which are located in various countries, and then try to inflate the invoice values so that the situation becomes favorable to the business to minimize the tax. Many of them were also doing binary transactions, and they were also trying to do the round tripping. So company may have the branches or subsidiaries established in various countries. Through those various subsidiaries, they were trying to round trip the transaction and then bring the transaction back or the money back to the origin by erasing the base so that you can actually manipulate the transaction form and then thereby get the benefit of taxes. So as I mentioned, in order to address this, the OECD came up with various action points. They are called as BEPS action points. So they came up with these 15 points in order to handle that particular issue that they've been facing. So now the OECD was already initially formed by 20 major countries, and then they later approached various other countries on the globe, and they were trying to encourage them to become the members because it cannot be handled by one country or few countries. This issue is there with the companies across the globe with their various business forms in and around the globe. So to address this or to handle this issue, they have to have all the countries' participation in this arrangement. So that is the reason why the OECD approached all the countries to become members. Most of them, I think as of today, it's about 135 to 140 countries have become members. And some countries have accepted to implement the entire full 15 action points or action plans. And most of the other countries, they have agreed to implement a few action plans out of this 15. So the selective 4 minimum standards are 4 plans that are actually given as a choice to the various countries. So UAE also is part of this particular arrangement. It is a member of OECD now. And UAE has agreed to implement 4 action plans. So the 4 action plans are those which have been highlighted in orange color. Say to so the counter harmful tax practices more effectively to implement and prevent any treaty abuses. The treaties that have been entered between the countries in order to encourage the businesses to have their setup being done. So there are various tax treaties entered by the countries. So in order to prevent any abuse of those treaties by the businesses, so what are the changes that are required to be done? And 13 and 14 points are also been agreed by the UAE to implement. So this is what with respect to BEPS action plans. And after this initial set of 15 plans, and then later they have also studied more and then came up with more suggestions. So that is actually called as BEPS 2.0. So in this, what they did is in order to address this specific business specific or company specific issues, they came up with 2 pillar plans, pillar 1 and pillar 2. Pillar 1 is specifically talking about or targeting the MNEs or larger MNEs, which has got a turnover of 20 billion euros or more at the group level. So these groups, what they will do is once the taxes have been actually paid by the company in the respective countries, they will look at the effective tax rate. For the MNC, the large MNCs, after completing all the tax payments, the remainder profit of the groups, the remainder profits of the group, 25%, up to 25% of that particular profit will again be reallocated to the countries. So how they're going to do it? Now they will take the group level profits and see that the group level profit excess of 10% margin will be taken as the remainder profit. And this profit, out of this profit, 25%, up to 25% of the profit amount will be redistributed to the countries where they have their businesses, the companies, businesses, or customer base is located. So this will be distributed to those countries. And as part of the pillar 1. And pillar 2 is going to be targeted or specific to the MNEs again, which are not falling in that particular category of 20 billion euros turnover or more. But this is a second category where the group level turnover is 750 million euros or more. So any group company that has got a group turnover of 750 million euros or more will fall under this pillar 2 category, wherein if the effective tax paid by the group in total, if that is less than 15%, the effective tax paid by the group on all the companies together of that particular group, if it is less than 15%, so they will make it up to 15%, and then distribute the difference amount of tax among the countries again. So this is the arrangement that they came up with. Pillar 1, Pillar 2, this is specific to the groups or MNEs which have got turnover of 20 billion or more, Pillar 1, and which have got 750 million euros or more in Pillar 2. And UAE will also be implementing this, but it is not effective yet. So maybe in 2024, this arrangement will become effective, in which case any companies which are falling in that particular group will have to comply with this. So because UAE also is part of this OECD and it is also a member, so that is why we are actually seeing the various laws that are being brought in UAE recent past. So just to name them, so the country by country reporting, which we have seen in somewhere 2019, which is also called as CBCR, this was implemented because of the UAE becoming member from in OECD. Many of the companies have also complied with economic substance regulations. This is an important regulation which is also going to complement implementation of the corporate tax in UAE. This primarily talks about the substance of the businesses to be in place in UAE, which means if you are saying that I have 100 million business in UAE, so to support that particular 100 million turnovers of business, do you have enough number of employees sitting in UAE or not? Do you have enough office space and facilities being present in UAE or not? Do you have an asset base which is actually able to generate 100 million business for you or not? So this kind of substance, you need to make sure that it is there in UAE. So this is what is being brought in to comply with OECD requirements. Of course, we all know that value-added taxes and excise tax also has been implemented. And for some of the companies or industrial service sector businesses, AML, anti-money laundering law, is also being brought in. And the scope has actually been increased over a period to bring in many other companies to be part of this particular network. And of course, now we are seeing at UAE corporate taxes. Okay, so all these are primarily in order to address the requirement of OECD have been brought in. So this is a background as to why we are seeing so many regulations of late coming into UAE and why corporate tax also is here. So corporate tax, now let's get into the corporate tax specific to UAE. This corporate tax is generally levied on the profits of the businesses or corporations. Value-added tax was on the revenue or turnover, but the corporate tax is on the profits, not on the revenue alone. So profits are generally the turnover or sales minus expenses will give you the profit amount. Of course, we'll have certain adjustments to this profit before we calculate the tax to be paid, corporate tax to be paid. But the bottom line is that the tax, corporate tax is generally calculated or paid on the profits of the businesses. This is also called as corporate income tax, CIT, in some other countries. It is also called as business profit tax. In addition to comply with the requirements of OECD, UAE also has brought in this corporate tax because of implementation of this corporate tax, the UAE will get additional funds, okay? And that will in turn be utilized for development of the infrastructure, facilities for the residents, and also for the development of the country and economy. So the corporate tax will definitely boost the economy of the country, and it will be helpful for the country as a whole and for the residents, of course, who are there in the UAE. However, the UAE and Dubai in specific is generally been considered as a global hub for most of the businesses. Okay, so UAE does not want to lose that particular status. In order to address that or handle that, UAE came up with a very competitive corporate tax. If you know, it is just a 9% on the profits after adjustments. This is generally considered as the lowest tax rate across the globe, leaving a couple of other small economies. So in order to retain that particular global leadership of being the global hub for companies or businesses to incorporate their businesses, they came up with the competitive corporate tax in UAE. So let's quickly look at the timelines that have been happened so far with respect to corporate tax in UAE. Initially, the Ministry of Finance, they have released a public consultation document on 31st January 2022, way long back. offering or asking the public, general public, to give their opinion on the public consultation document. So they're given enough amount of time for us to get back to them, and then afterwards, they came up with a decree law somewhere in December, on 9th December 2022. So public consultation document was not considered as a law as such, because it was only a consultation document. But this, the decree law that has been released, is actually is a law. It is an act that's going to come in for sure, and it has already been enacted in October itself. And afterwards, or on the same date, rather, they have also released frequently asked questions, which actually give a little bit a generic idea or general idea of the decree law and corporate taxes. And later in January 2023, on 16th January 2023, they have also released a cabinet resolution with respect to the decree law. I'm not really sure how many of you are aware of it, but there was a resolution released. In this particular resolution, they've only given one or two topics. In specific, they are giving the base amount of profit, which will be considered for zero taxation and 9% taxation, that we will see in the later slides. Afterwards, the Ministry of Finance should come up with various other cabinet decisions. As I mentioned, the major ones are with respect to the individual income, how the individual income will be taxed. Do they consider any part of the income for consideration of or for the taxation of corporate tax? And another important, most awaited cabinet decision is with respect to the free zones incomes. They have given a rate to be implemented or rate to be applied, but on which all incomes or which all profits, those respective rates will be applicable. So that definition is not being released. So these are the two major areas where we require the cabinet decision or executive regulations to understand it well. So this being the limitation, so we will discuss what are being released or issued in decree law as well as in FAQs in our further slides. So when is it going to be applied for? They have clearly mentioned that UAE corporate tax will be applicable for the financial years on or after 1st June 2023. So the applicability of corporate tax is linked to your financial year. So this financial year may vary from company to company. Generally, it has been mentioned in the registration documents of the company when you incorporate a company. So most of the businesses in UAE, generally they follow January to December, just calendar year, as their financial year. But some other companies, they have their own specific calendar years, which could be from July to June, or October to September, or April to March. Some of the Indian companies, they have their financial year as April to March also, because back in India, so they have April to March as their financial year. In order to sync with that, some companies prefer to have April to March. Since I mentioned that most of the companies have January to December as their financial year, if your company's financial year is January to December, for your company, the corporate tax will be effective or will be applicable from 1st January 2024 onwards. So first financial year for which the corporate tax is applicable for you is 1st January 24 to 31st December 2024. So before we get into the other main concepts of the law, let's quickly understand the geographic form or various forms and legal forms that are currently in place in UAE. UAE, in geography wise, it's been divided into mainland, free zone. Of course, we also have some entities in the form of offshore, where there's no physical place for them for incorporate. And these free zones, as we know, they are further bifurcated into the financial free zones and other than financial free zones, the other free zones. Why we are talking about this? Because the rules that are mentioned in corporate tax are going to be specific to each of these particular geographies. So that is the reason why we just need to understand this. And similarly, the legal structure or legal forms of the entities in UAE are different. Depending upon the form or legal form of the particular organization or entity, the rules in corporate tax are going to be different. So just to say, limited liability company, which are called as LLC, which actually the most of the significant portion of the firms, organizations are in UAE. Free zone companies, public share holding companies, sole proprietorship, private shareholding companies, branch of foreign companies, civil companies, branch of UAE business company, partnership, representative office, foundation or trust, freelancers. So these are the various forms of organizations that are in place in UAE currently. So now we are getting into the basic concept of the decree law. These are the some of the crucial or critical areas, understanding which is more important for us to decide the applicability of corporate taxes for a particular business. So let's look at it. As I mentioned, tax is generally levied on the taxable income at a rate that is being determined by the decree law. What is the rate? The rates are like this. The general rates are up to 375,000 dirhams, it is going to be 0%. So the taxable profits up to this 375,000 dirhams is going to be taxed at 0%. In excess of 375,000 dirhams, it is going to be taxed at 9%. So this is for most of the mainland entities, it is going to be applicable unless anything else is mentioned in the further decree laws. So this is 0% tax up to the amount of 375,000 dirhams and 9% in excess of 375,000 dirhams for the profits, on the profits. For qualifying free zone persons, it is different. How? It will be taxed at 0% on their qualifying income. So qualifying income means the qualifying portion of the profits. So that will be taxed at 0%. And profits or the incomes which are non-qualifying, in other words, non-qualifying incomes are going to be taxed at 9%. So for all the free zone persons, your income will be categorized into a qualifying income, non-qualifying income. Qualifying income will be taxed at 0% and non-qualifying income will be taxed at 9%. It will be discussed in detail in the future slides, but these are the rates that are actually being given in the decree law at the moment. Now let's look at the persons. Persons include natural persons and juridical persons. Natural persons means the individuals, and juridical persons are the persons which are legally incorporated or registered. They are called as juridical persons. So this is the broad classification that we are looking at. And those persons can be classified for corporate tax purpose into exempt persons and taxable persons. Okay, so this is the broad category of the persons that we can see. Now let's look at the exempt persons. These are the category of companies or businesses which will get a benefit of being exempted, which means they don't need to comply with the corporate tax laws like registration, filing, and other things. So these are the four categories of exempted persons that are being given in the decree law. Needless to say that government entities and government controlled entities, they fall under exempted persons. Only if they conduct those activities which are actually being mentioned in the particular law under which they have been incorporated. If these government entities and government controlled entities conduct any other commercial activity or a business activity, that particular commercial activity or business activity will be taxed. That should be treated as an independent business, and accounts and books of accounts should be maintained separately for them. And further compliances of corporate taxes should be adhered to for that particular business. So this is with respect to the government entities and government controlled entities. They by default will be considered as exempt persons. The second category of exempt persons are, they will be exempted only if it is notified to Ministry of Finance. There are certain more conditions given to these organizations, and the organizations are which are falling under extractive business of natural resources. All the organizations and businesses which are performing the extractive business of natural resources. Also, the businesses which are still part of this extractive natural resource business, but not directly extracting them. So these organizations will be considered as exempt persons. There are other conditions. One important condition being that they are currently already being paying some tax to each of the Emirates, to the respective Emirates. Just to tell you guys that currently we have a corporate tax, though it is not called as corporate tax, at Emirates level for two categories of businesses. One is for the businesses which are engaged in natural resource extraction, and second category is the branches of foreign banks. So these two already are being paid the corporate taxes at Emirates level. So the logical thing to say here is that since the extractive businesses and non-extractive natural resource businesses, they are already paying corporate tax at Emirates level, so they do not want to bring them again into federal corporate tax. So that is the reason they have been given the exempted status. They have to comply with those conditions that are mentioned in the decree law to get this exempted or to continue to have this exempted status. The third category of exempted organizations or persons are the qualifying public benefit entities. These are the entities which are actually conducting some activities which are benefiting the public at large. And they should be mentioned in the cabinet decision of the ministry. That's when they'll get the benefit of exempted persons. The qualifying public benefit entities are for example, are like religious based, social service based, or they're conducting some research. So this kind of activities they are doing, which are primarily incorporated for not profit purpose. So they are only conducting the activities which generally benefit to the public at large at no profit. And they should be part of the cabinet decision mentioned. And the last category of exempt persons are the public pension funds, private pension funds, social security fund, qualifying investment funds, and any other wholly owned and controlled subsidiaries owned by the government controlled entity, pension funds, and qualifying investment funds. So these are the entities which fall under fourth category of exempted persons, and if they have to apply to the ministry or FTA to get the exempted person status, otherwise they will not get by default. So this is the list of exempted persons which are generally being mentioned, which are mentioned in the decree law. Let's quickly look at the taxable persons. So we have seen who are exempted. Now let's see who will be taxed. Okay, and this is what is generally mentioned as tax base. Broadly, they can be categorized as resident persons and non-resident persons. And resident persons again are classified into juridical persons and natural persons. The juridical persons can be a company which is incorporated in UAE and it has got a recognition or establishment in UAE. Of course, they'll be taxed to corporate tax in UAE in full. Apart from this entities, even free zone entities are also considered as being incorporated in UAE. They'll be considered as resident juridical person and they'll be subject to tax in UAE. Not only these two categories, even the entities which are incorporated outside UAE, but those are effectively controlled and managed from UAE. We'll look into this a little bit more in detail in the future slides. But these entities are not actually being incorporated in UAE. They are incorporated outside UAE, but the business is actually managed and controlled from UAE. Then they will be considered as resident for corporate tax purpose, and they'll be subject to tax in UAE itself. And the second category is natural persons. Natural persons, if they are conducting any businesses, any business income that is related to the business conducted in UAE, or business conducted outside UAE, specific or related to the business in UAE, will be subject to tax and corporate tax in the hands of natural persons also. If they mention any other category of persons, they'll also fall under this determination, this resident category to be taxed. Now let's look at the non-resident category of taxable persons. Non-resident persons means the companies which are incorporated outside UAE. So how the tax will be levied on them. So if that particular non-resident person has a permanent establishment in UAE, so which will be considered as permanent establishment, that again we'll see in the future slides. If they have any permanent establishment in UAE, though they are non-residents, but they will be subject to tax in UAE again. And the ministry also has mentioned a nexus. If any non-resident has got any nexus in UAE, the business income relating to that particular nexus will also be subject to tax in UAE. So what is nexus is not defined in the decree law yet. So that we'll have to wait and see in the future decree laws or future decisions from ministry. In addition to this, any non-resident, if they derive any UAE sourced income, that will also be subject to tax. This again we'll discuss in detail in future slides. So this is the broad category of taxable persons, which are into resident and non-residents, and then so forth. So branch being a very common form of business, which has been actually arranged by many of the organizations. I just wanted to touch base on this. Generally, for all the residents, branch is not considered as a separate entity for corporate tax purpose. It is considered as part of the parent or head office. So branch has no separate entity for all the resident juridical persons. So needless to say that any income that you generate from that particular branch will be included in the income of the parent or head office. Okay. So for the branch for corporate tax purpose, there is no separate registration required, and the branches of foreign entities is generally being considered as having a permanent establishment in UAE for that particular non-residents. They want to say that it is not a permanent establishment for them. They have to prove so that it is not a permanent establishment. For the branches of UAE which are situated outside UAE, they are called as foreign branches of UAE businesses. For them, there are two options given. One is that they can include the entire amount of that particular branch as part of the parent company in UAE, and then will be subject to tax in a normal, under normal rules. The second alternative is that the UAE business can elect to exempt that particular branch in total. So either you include the full amount and be subject to tax in UAE, or you completely eliminate or apply for exempt of that particular foreign branch. There are certain other conditions also to be met, then you can do so also. This is a, let's quickly go through some of the arrangements that generally we see with respect to the branches. If a Dubai LLC is there, and they have got a branch in free zone, let's say in Adabza. So this free zone operations, where will that be included for the purpose of taxability? It will be included in Dubai LLC. As I mentioned, the branch is part of the parent or head office. So because the Davza branch should be considered as part of the Dubai LLC, which is main, which is the parent. So the income of this particular branch will be included in the head office. Let's say that the head office actually is located in free zone, and they have a branch in mainland. So we need to think where this Sharjah branch in mainland operations will be included in. Will it be taxed separately in mainland, or will it be taxed as part of the free zone head office? The answer is that it will be included as part of the free zone head office, because the mainland Sharjah branch is a branch. Only thing that we need to be careful or look at is whether this particular branch, which is mainland, the income of that or profit of that particular branch will be subject to tax at 0% or 9%, or will it be taxed at a normal mainland rates? That's what we need to be decided once we get the further decisions or decrees from the ministry. Let's say that there is a free zone license, but that has actually been managed effectively from mainland. Most of the service oriented free zone licenses, the individuals generally own them. They only own license from a free zone, but they actually manage the business from mainland. So in this scenario, how the tax will be levied? They don't have any branch office in mainland. They only have one license, which is in free zone, but that is actually being managed from mainland. We need to wait and see how this will be implemented in the further decrees. Okay, so this is with respect to the branches. So let's quickly look at what will be taxed in the hands of these persons. So far we have seen who will be taxed. Now we are going to see what in the hands of those people will be taxed. In the case of residents, if it is a juridical person, any income that is derived in UAE will fully be considered for taxation purpose. And any income that is derived from the rest of the world will also be taxed here in UAE in the hands of companies or corporations if that business is managed and controlled fully from UAE. Okay, so total UAE income as well as income from outside UAE, if it is managed effectively from UAE, will be subject to tax in UAE in the hands of resident juridical persons. I mentioned juridical persons means legal persons. What about the income of natural persons? If the income is derived in UAE or from UAE, or income is derived from the rest of the world, will be subject to tax only if it is a business income. Okay. So since we are talking about the taxation in the hands of individuals, I also mentioned clearly that the taxation with respect to individuals' income is not fully been mentioned in the decree law, how it will be taxed and all. So we are waiting for the further decrees to be released on this particular topic. But there are certain points which are mentioned in the frequently asked questions by Ministry of Finance. Based on that, I just prepared this, that no salary income and any other income in relation to the employment is not subject to tax. Real estate income in the hands of individuals, if it is sourced out of the personal income, that will not be subject to tax. Returns on investments by an individual, if it is dividend and capital, so that is also not subject to tax as long as this investment is done out of your own personal income. Income earned from bank deposits, something like interest or others, will also be not subject to tax in the hands of individuals. Foreign investors, any dividends they receive, capital gains, interest, royalties, or similar returns, they will also be not subject to tax in UAE. But if any individual has got any freelancer license and they are providing any services as part of the freelance license, they will be subject to tax. Of course, they'll have a base amount of 375,000 subject to 0% and all, but this will be subject to tax in the hands of individuals if they have freelance license. Yeah. So we have seen what will be taxed in the hands of non-residents. Let's see what will be taxed in the hands of non-residents. Non-residents, as I mentioned, they are the companies which are incorporated outside UAE, but they have a business in UAE directly or indirectly or whatever it is. So if they have any income which is sourced in UAE, the non-residents have income sourced in UAE that is not attributable to any permanent establishment, then it will be still subject to tax. So we'll talk what is permanent establishment and all, as I mentioned. But in the hands of non-residents, they source any income from UAE, so that will be subject to tax. So what is called as an income which is sourced from UAE? Any income that is derived from a resident person in UAE by this non-resident person, that will be subject to tax. Or the non-resident company is paying or earning some income from another non-resident person, but that is in connection with a permanent establishment in UAE. So non-resident companies or persons are actually doing the business or transaction, but that is actually in relation to our permanent establishment in UAE. Then that particular transaction also will be called as UAE source income in the hands of non-resident, and that will be subject to tax in UAE. Other forms of UAE source income are like, if non-resident is performing any activity in UAE, or non-resident has got an asset which is located in UAE and they are generating income out of that, or they're getting income out of any capital investments made in UAE by a non-resident, or non-resident has got any right in UAE out of which he is generating the income, or any other services performed in UAE out of which he is getting the income. So the profit out of that particular or that income will be taxed in UAE under UAE corporate tax laws in the hands of non-resident. The second category is income attributable to permanent establishment of NR in UAE. So any income that is specific to or in relation to the permanent establishment owned by the non-resident will also be subject to tax in UAE. Third category is income attributable to any nexus of non-resident in UAE also is going to be subject to tax. What is nexus? The definition is not mentioned by the ministry in decree law yet. So we'll have to wait and see what it is going to be. So in the hands of non-residents, all these will be subject to tax in UAE. If this non-resident, if they have any permanent establishment in UAE, so they'll be subject to tax in UAE, as I mentioned earlier. If they don't have any permanent establishment in UAE, so it may not be subject to tax in UAE. So as I mentioned in the initial slides, any particular country, they can only levy tax, or they will get the right to levy the tax only on the businesses that are established or businesses that are conducted in UAE, or if the foreign persons have any permanent establishment in UAE or in the particular country, that's when they'll get this right to levy tax on them. So when they go for the taxation of the income of non-residents, they also need to look at, or one should look at, the treaties that are being generally entered by UAE with the other countries. There are various treaties that have been entered by UAE with other countries with respect to the taxation of these cross-border transactions of businesses. So if there's any specific rule which is in contradiction to the rule mentioned in the decree law of UAE, then the rule mentioned in the treaty will prevail. Means that rule should be applied, not the UAE law mentioned with respect to cross-border transactions. So here what I was trying to say is that any income that is attributable to a permanent establishment of a non-resident will be subject to tax in UAE. So let's look at when or how a non-resident will be called as having permanent establishment in UAE. They're actually incorporated outside UAE, but they have some form of business being conducted through some channels. So the rule one or the test one is that the non-resident person has a fixed or permanent place in UAE. They are not registered in UAE, but they have a fixed or a permanent place in UAE through which they are conducting some business activities. So if they have that, then that non-resident will be considered as having permanent establishment in UAE, and then the tax, therefore the tax will be levied on that particular business income. Rule number two is non-resident person has and habitually exercises an authority through another person. They don't have any fixed or permanent place here, but they have someone, the natural person, who is actually taking decisions on behalf of non-resident, which means through that particular person they are conducting business. Then also the non-resident will be considered as having permanent establishment in UAE, therefore it will be subject to tax. Third test is a non-resident person as any other form of nexus. As I mentioned, nexus definition should come out from Ministry of Finance. So if they have this also, then it will be subject to tax anyway. So let's quickly look at what will be considered as having place of business, a fixed place of business for non-resident person. If they have any place where they take decisions, management is actually sitting in a resident or somewhere and they are taking decisions with respect to business of a non-resident. Non-resident person has got a branch in UAE, then it will be called as permanent establishment for them. Any factory, if they have any office, including a temporary field office or an employee's home office, the business is actually conducted from an employee of a non-resident person in UAE. Then that particular office or resident of an employee will be considered as a permanent establishment for non-resident, and any income generated out of this particular activity will be subject to tax in UAE. If the non-resident has any workshop or land, buildings or other related properties, if they have in UAE, these are also considered as permanent establishments for non-residents. Installations and structures used in the exploration of natural resources, they will be subject to tax. If non-resident has own any mine or oil or gas wells or acquire quarry, then they will be considered as permanent establishments for non-residents. Any income generated from them will be subject to tax in UAE, though they are not registered in UAE. If they own any building or construction site or place of assembly, and activities have been conducted from that particular place for a minimum of 6 months or more, then any income generated from that particular place will be subject to tax in UAE for non-residents. On the other hand, non-residents, if they are conducting any preparatory or auxiliary activities, it's not their core business, but that particular non-resident person is only conducting some preparatory or auxiliary activities from that particular fixed establishment, then it will not be considered as a permanent establishment for them. So then it will not be subject to tax in UAE. So what are the preparatory or ancillary characteristics? Like, if non-resident conducts any limited marketing or promotional activities, or they perform any market research just to understand whether it is going to be feasible to do business in UAE for my activity or not. For example, FCO, which is situated in USA, they want to conduct a survey in UAE through a fixed place of business. Someone, maybe they engage someone, or they are asking their employee to go here to UAE and see whether is it going to be feasible to conduct any business in UAE for our activities or not. So if that is the activity conducted through this permanent fixed place of business in UAE by non-resident, then it will not be considered as P, and the income generated out of that will not be subject to corporate tax. Likewise, attending seminars or conventions by non-resident employees are not considered as Ps. If they store any goods in UAE or display any goods, the non-resident does not have any place here of business, but they only display in some company or some showroom of their products. Then it will not be considered as PE, and so other activities. Let's quickly run through an example. Let's say there is a company in UAE and that has got a branch in Singapore. And this Singapore branch is conducting full activities related to this UAE company business. Okay. Since Singapore branch is conducting activities, so Singapore will have the right to levy tax on the income of Singapore branch. But since it is a branch of UAE company, so UAE government also will have the right to levy tax on the branch income. Okay, so this is a scenario. So you are paying tax on your branch in Singapore itself. And in UAE also, you will be subject to tax for the branch profit in UAE. Okay, so these are the rules. Now, you may have a question saying that you are paying tax in Singapore as well as in UAE. So is it not going to be subject to tax twice? So for which there is a concept called foreign tax credit, which we will see in the future slides. So you will be allowed to take a credit of tax paid in Singapore already, and then pay net amount of tax only in UAE for you to UAE government. Of course, there are certain conditions to be met, but this is how the double taxation effect will be removed. So as I mentioned, the permanent establishment can also be determined by a second rule of agent test. The non-resident, they do not have any permanent establishment or fixed place of business in UAE, but they are conducting through an agent who is fully dependent on them. Then also the non-resident will be considered as having place of establishment in UAE, and they will be subject to tax in UAE. Of course, if they are conducting the business through an independent agent who is not directly connected to them, then it will not be considered as having PE in UAE, and hence they will not be subject to tax in this model. How to determine whether a particular agent is considered as independent or dependent? So these are the conditions that we need to look at to determine whether an agent is a dependent person or a dependent agent or not an independent agent. Let's look at an example. FCO company, a foreign company based in USA, is engaged in investments in real estate activities in various countries. So F company engaged a real estate agent called S Real LLC in UAE to assist them in identifying the investment opportunities in real estate in UAE. So they want to get into UAE market. So they have engaged one real estate broker or agent to suggest them if there are any potential investment opportunities. And this S Real Estate, which is a real estate broker or agent, they also generally provide services to other clients. On top of it, that S Real LLC charges its commission on the services provided to the clients at market rate. So they don't depend, or they don't manipulate the commission. They just have their own standard commission rates, and they charge according to that rate. So to anyone, whoever is taking their services. Now, in this case, we need to determine whether this S Real LLC, which is a real estate agent, is it considered as a dependent agent for FCO or not, because they are providing some services. But there are a couple of indicators given in the example that S real estate company also provides to other companies, services to other companies. So this S real LLC is not fully dependent on FCO, and the S real LLC is also charging their commission at market rate. So this gives an indication that this is an agent which is not acting as a dependent agent for FCO. Hence, this S3 LLC will be considered as independent agent for FCO. Therefore, FCO is not considered as having PE in UAE. Okay. So let's quickly look at the takeaways out of the slides that we went through so far. What do you have to do? Now, what is that you have to look at it now? These are the few key takeaways that I would summarize. Now, check if the financial year followed by your company is according to the legal documents. Some of the companies, without knowing, they may have April to March as their financial year mentioned in their incorporation documents, but they are actually following January to December. So this becomes a conflict. So you need to look at the incorporation documents and make sure that the financial year what you're following is as per the legal documents of the company. So these are the things that were not so important so far, but now we have to look at them. In certain cases, the memorandum or other legal incorporations, they don't specify any particular financial year in that. But there is a rule saying that the financial year shall be determined by the company or by the board of directors through a resolution. So if that is the case, then we have to have a document in place mentioning the financial year, what is that you are proposing, and have that in place. Otherwise, there will be a question later on if you're not having enough documentation to support your financial year dates. Also check if you are part of a group and if any business has a potential to be considered as exempt person, then you have to apply for the FTA to consider them. So this is something that you need to look at now. Also review the legal structure of the businesses and the location from where they are operating, how and where the business is actually being done, to be able to see how the corporate tax will impact their business. So the legal structure and the locations and the business arrangements, all these things, they have to look at it now. Since we have seen the taxable persons, non-taxable persons, and so forth. So you need to now look at the structure and make sure that it is in favor of the business. Check if any of your outside UAE entities or businesses could fall under taxable persons. You may think so far that since the business is outside UAE, so it may not be taxable in UAE. But now you need to relook at that and see whether it is really so that it is not subject to tax in UAE. If you have any foreign branch, then you need to look at the decision that you have to make, whether you want to consider that the foreign branch as part of your UAE entity, or do you want to exclude that in full, and then therefore that will not be subject to tax in UAE. So that's what. So these are the few things, a few areas that you need to look at out of the slides that we have discussed so far from the point of view of implementation and planning. Now let's look at the second category of the session, which are more relevant from the point of view of your accounting. Exempt income, expenses that are deductible, and expenses that are not deductible for corporate tax purpose. Let's see what are the exempt incomes. So these are the incomes that are not subject to tax. Okay, so though you may have these incomes, but when you submit your corporate tax, you'll be excluding them from computation of taxable income or taxable profit. So what are they? Generally, the dividends and other form of profit distributions received from a juridical person, that is a resident in UAE. So any dividend or any other form of profit distribution received from UAE company. So this could be received by a company or an individual. So that will not be subject to tax. The reason being that this particular company in UAE is already being subject to tax. After paying the taxes of the company, that company is distributing dividends to the investors, so it will not be subject to tax again. Second category is dividends and other profit distribution received from a participating interest in a foreign juridical person. First point is about the dividend received from a local company. Now we are talking about dividend received from a foreign company. So you have investment in a foreign company and you receive dividend from that particular company. You need to see whether that dividend or profit distribution will be subject to tax or not. So there's a particular term used, participating interest here. So that is crucial to understand. So participating interest means you as an investor is owning minimum 5% of the share capital voting rights of that particular foreign company. And you also have eligibility to get more than 5% of the profit distribution. And there are a few other conditions to comply with. If that being the case, then it will be considered as participating interest, and any dividends or profit share that you get from that particular investment will be exempted income. Okay. So in the first 2 points, we have seen the dividends and profit distributions we have seen from the investments. The third point talks about any other income that you receive from participating interest. So you are a shareholder in a particular company and you're receiving other incomes. What are other incomes? Other incomes other than dividends, which are capital gains. When you sell your investment, you may get profit or loss. That is considered as capital gain. Or any foreign exchange gain or loss out on the investment. Or any impairment gain or loss on the investment. So all these are considered as other income. So that other income in the hands of the investor will be exempted only if they comply with this participating interest condition again, which we discussed in point number 2. Income of a foreign permanent establishment, we discussed in the features in our previous slides. Income of a foreign permanent establishment that they own, they can elect whether they want to be subject to tax full, means you have a branch outside UAE, and that outside UAE they are conducting business in full. So that will be considered as foreign permanent establishment for UAE company. As I mentioned, you can either elect to be subject to tax in full, or you can elect to be exempted. So if you elect to be exempted, that's when it is called as falling under category 4. Income derived by a non-resident person. This is also non-resident person who are operating aircraft or ships. A non-resident person who is into the aircraft or ship operating business in the international transportation, they are also exempted. The only condition in that the respective country also has reciprocal rule, which means, for example, let's say that company A is established in USA and they are conducting aircraft and ship maintenance, ship operating business in international transportation. And if they have any income in UAE, and that will be exempted only if USA is also allowing UAE-based companies to consider their income as exempt income. So both the companies should have similar rules. That's when it will be exempted in the case of non-resident businesses operating aircraft and ships. Now we need to look at the deductions. Our deductions are with respect to the expenses. For this, I invite my colleague Pratiksha to take it forward from here. Pratiksha?
Thank you, Sam. So now we will be speaking about the expenses which are deductible and computation of taxable income and corporate tax. So the expenses which are incurred exclusively for the business in the tax period are allowed to be deducted. So the expenses which are revenue in nature are deducted. So if you have spent any expenses in purchase of your fixed assets, which is capital in nature, will not be allowed as a deduction in the current year. but this expense will be allowed as a deduction in the later years in the revenue form in the form of a depreciation. As we spoke earlier, certain incomes are exempt from corporate tax. So the expenses which are incurred to earn such income are also exempted. So this expenses which we have incurred will not be allowed as a deduction. And any other expenses which is specified by the cabinet decision can also be included here. So if you are having multiple expenses which are relating to your business and in personal nature, and if you can identify the nature of expense which is for personal and business nature, so the part of the expense which is relating to the business, only that expense can be allowed as a deduction. Can you change the slide? Okay. So as we spoke earlier, expenditure relating to we will be speaking about some non-deductible expenses. So the expenses which are incurred to earn exempt income are not allowed as a deduction. Speaking further about the following points, we'll discuss in more detail in the further slides. Next. So there is a special provision in relation to the interest deduction. So net interest expenditure. Net interest expenditure is interest expense minus interest income will be allowed to be deducted only up to 30% of EBITDA. What is EBITDA? EBITDA is earnings before interest, tax, depreciation, and amortization. So only 30% of your interest expenditure up to EBITDA is allowed to be deducted. So for example, if your EBITDA is 100,000 and your interest expenditure for the current year is 40,000. So 30% of EBITDA is 30,000. So only 30,000 of your interest expenditure will be allowed to be deducted in this current year, and the balance 10,000 of your expenditure will be should be carried forward for next 10 years. This net interest expenditure, which is not allowed in the current year, is allowed to be carried forward for only 10 subsequent years. So for example, if you're not able to set off this interest expenditure for the next 10 years, this interest expenditure gets lapsed in the 10th year, and you will suffer a loss in that regard. So for the calculation of EBITDA, exempt income shall not be taken into consideration. This provision which we discussed now is not applicable to banking company, insurance company, and a natural person who is undertaking business activities. Next. Speaking in more detail about interest deduction for loans between related parties. So this provision is related only for the loans between the related parties and the interest given on the loan. So if related party A is giving loan to related party B for these following 4 purposes, that is for the purpose of payment of dividend or for profit distribution or for redemption of shares or as a capital contribution or as for acquisition of a stake in another company. So if for these 4 purposes you are paying interest to a related party, this interest expense is not allowed as a deduction. So, but the government will have to actually get into more detail and will have to get into the nexus to find out whether any interest expenditure which is incurred is for the following 4 purposes. Also, these companies, if they are taking loan from their related party for any other purpose other than these 4 purposes which are mentioned here, the 30% clause will apply. 30% clause of that EBITDA will apply. Next. A special provision relating to entertainment expenses. So what are entertainment expenses? Entertainment expenses are meals, accommodation, transportation, admission fees, or like this. So these expenses which are mentioned here is not the limited list. This is shall be an exhaustive list, which means it will not include only these items. Some other items or some other expenses which can corroborate as entertainment expenses can also be forming part of this provision. And such expenses will only be allowed only up to 50%, which is incurred for the customer, shareholders, suppliers, and business partners. So if these expenses, these entertainment expenses are incurred to any party, which is mentioned here, is only allowed up to 50%. And if these expenses are incurred for the employees of the company, 100% of these expenses are allowed. Moving further, these are some other non-expenses which are not allowed to be deducted. So if you are paying any fines and penalties to the government is not allowed. So if you are paying any a penalty for late filing of your VAT return, or if you are paying any fines which such as traffic fines to the government, so these expense is not allowed. But if you are paying any penalty for breach of contract between two parties, so that penalty which you paid for the breach of a contract is allowed as a deduction. Secondly, the donations which are given to an entity which is not a qualifying public benefit entity, that is not allowed. So the donations which are given to a qualifying public benefit entity, which is listed by the cabinet decision, only the donations given to these entities is allowed. Further, input tax credit, which we have claimed in our VAT return, is not allowed as a deduction for computing corporate tax. Other than these bribes or illegal payments which you are making to any other person, obviously is not allowed as an expenditure. Further, if you are having any company or a foreign or an establishment which is in a foreign company, and that company is paying tax in that country, so the tax which is paid in that country is not allowed as a deduction here. But obviously, after computation of corporate tax, when paying the final tax, you can take the credit of this foreign income tax when paying the final tax to the government. This is discussed in more detail in the later slides. Moreover, the corporate tax which we will be paying to the government is not allowed as an expenditure. And some other dividends and profits which are distributed among the partners, or if it is a sole establishment and that owner is withdrawing some profits from the business, those expenses are also not allowed as a deduction. We'll be going through an example to understand these things in a better way. So the gross revenue of the company is 2,200,000. And the direct and indirect expenses amounts to 1,700,000. So the book profit of the company is 500,000. So the book profit is computed only on our accounting standard basis and without giving effect to the deductions which we discussed earlier, exempt income or any other expenses which we discussed earlier. So now, based on the law which has come out, and we see that our interest expenditure is disallowed. So we'll add our interest expense to the book profit to come to a taxable income. So a taxable income comes to 600,000. So as we know, the rate of a corporate tax is 0% up to 375,000 and 9% on the balance profits. So up to 375,000 to the 0%. So on balance 225,000, tax of 20,250 will be payable in this example. So to summarize further and to understand things in a better way, so now we will have to review the incomes such as what is the dividend income, capital gain, or any interest which is received, and so these incomes are exempted. So the expenses relating to such incomes are also exempted. So we'll have to make a clear bifurcation of this. We'll also have to identify our personal expenses. So because earlier we used to debit our personal or company expenses all together in a company books of accounts. So now personal expenses will not be allowed. So you will have to identify the personal expenses and eliminate this. We'll also have to make a proper policy for the asset capitalization. As we saw, there are specific provision for interest deduction for related parties and any other party. So we'll have to make a proper bifurcation of this interest expenses. So similar for entertainment expenses, we'll have to make a bifurcation for expenses which are incurred for employees and the expenses which are incurred for other stakeholders like shareholders, business partners, and customers. Also, bifurcation for penalties and donations. And the VAT, which we might have forgotten to claim in our VAT returns, or some of the VAT which is just allowed to be taken in our VAT return. So if that unclaimed VAT input we are having, we can take that as an expense in our corporate tax, and that can be taken here. So that bifurcation needs to be maintained properly. And it happens so many times that certain business expenses are incurred by the owner itself. So if those expenses are incurred by the owner of the company, and if they can be accounted properly in our books, so that can also be taken as our expense, and the benefit of this can be taken. So these are the items which we need to keep in mind when doing accounting, and we'll have to keep a clear bifurcation of these things so that we do not end up with mistakes or missing out some things at the end. So my colleague Manish will take forward from here.
Yeah. Thank you, Pratiksha, for taking us through the deductible expenses. Now I'll talk about what are the group structures and what is qualifying group and how do we carry forward the losses. So yeah, next slide. As Balram has already talked about, the jurisdiction person, resident person. So judicial resident person are the one who are incorporated in UAE. So the first criteria to form a tax group is that they need to be a resident which are incorporated in UAE, not an individual, and there need to be a relationship of parent and subsidiary between those two. So, and that ownership interest has to be there of 95% between through the voting rights or profit sharing, and it could be direct and indirect. So when we say direct, a company A, which is established, incorporated in Dubai, is owning having a stake in Sharjah of 100%. So they both can form a tax group. Whereas it could be through third party as well, the indirect. So where it would not be directly getting the shares of a company B, which is a third party, and company A and C having a direct relationship, but C has a direct relationship with the company B. We'll look at that example on the next slide. And parent and subsidiaries should not be an exempt and qualifying free zone, because these are not paying the corporate tax, so they cannot form the tax group, and they need to be a same financial year. So the financial year, if there is a financial year from January to December, then all the subsidiaries should form, the parents should also prepare the financial year from January to December. It has to be same, because if we have a different financial year, then the income cannot be grouped together, the expenses or whatever the transactions cannot be grouped together. And also same accounting standard, which is generally the IFRS being followed. So all the companies, subsidiaries, and parents should be preparing the same financial standards, following the same standards. And so all these criteria need to be met to form a tax group. And for forming a tax group, a parent and a subsidiary need to submit an application to the tax authority, FTA, that they are going to form the tax group. And the application can be submitted anytime during the year. So like if they're submitting the application in the month of March, then that get effective from the starting of the financial year. From 1st January, that will get effective. So if they're submitting the month of, say, March 2024, that will get effective from 1st January 2024. Next slide, please. Yeah, so this is an example where Dubai parent company having 100% stake in Sharjah, so they can form a tax group. An indirect relationship, a Dubai parent company having stake in Sharjah 40%, and Fujairah is, Dubai parent and Fujairah is having 100% stake, and Fujairah is having 60% stake in the Sharjah. So indirectly, Dubai parent company can form a group together with Sharjah and Fujairah. Next slide. So now, once this tax group has been formed, what is the benefit, or what is the impact of it? The first benefit comes out to be because of the tax group, the documentation, that the submission of the forms, that will be limited to the only parent company doing this activity. And then it would be a single taxable person. The single taxable person means that the limit, the group will be considered as a one taxable person. There's a one tax registration for the group. And as well as the income which is taxable the limit of 375,000 will be limited to the group. It will not be considered each individual company wise. So Sharjah and Fujairah will not have a separate limit of 375,000, but Dubai, Sharjah, and Fujairah will be combined considered for a taxable limit of 375,000 profit limit. And then yes, parent company has to form this registration, filing of returns, and the payment has to be done. And then they need to prepare a consolidated financial statement. So each of the subsidiary will prepare their own financial statement, and then when they are filing the return, they need to combine these transactions, prepare a consolidated financial statement. And any kind of intergroup transactions which is taking place, that will be net off. So the benefit of the transfer pricing documentation, which has to be required if they're not forming a tax group. In the tax group, they don't have to worry about the transfer pricing documentation that is in detail required. So that gets a benefit in terms of administrative activity. Then parent subsidiary will be jointly liable in terms of tax which are there. So it's not, if parent is not paying, then the subsidiary has to pay out of their income the tax which is for the group. And then tax group may cease to operate if they are not meeting the criteria, like if 95% ownership interest is not there, or if some company or some business become exempt category, then they cannot form, or if some of them become a free zone qualifying category, then they may not form. So the group may cease to discontinue with the tax group structure, or even the parent company can also apply for replacing it itself. Like, someone has taken over a company, Dubai company has been taken over by some other company. So the company which is taking over can apply to be a parent company to the authority. Next slide. Now, if someone is not able to form a tax group as they are not able to meet 95% criteria, but then they can still be able to take a benefit of the same group tax losses. Now, how does that happen? The first criteria is they need to be again a judicial resident person. That means those companies need to be incorporated in UAE. And then if they need to have a 75% common interest in between, the ownership interest among this group should be 75%. And start to end is basically, it has to be from throughout the financial year. So it has to be from 1st January till December end, that interest should remain, should not change in between. And then, of course, they cannot form if it is an exempt or qualifying free zone because they are not paying the corporate tax. And then they need to maintain the books and account, follow the same financial year, and accounting standards should follow the same, so able to club together. And any kind of transaction which is taking place in between and of an assets movement, it can be done at net book value. So there will be no profit or gain when the transactions are taking place within that group. And the maximum of 75% taxable income can be transferred. We will look at the next example. Just move on to the next slide. So here is company A and B. The revenue is 2 million and 3 million. So company A get a loss of 550,000. Now this 550,000 can be claimed, can be transferred to the company B, which is forming a 75% group. So, if you see that company B is having a taxable income of 600,000. So if 600,000, the 75% limit applied to is 450,000. So up to 450,000 of company A loss can be claimed from company B. So the amount, the profit which derived from company B is 150,000. And the whole objective of limiting to certain amount is that we know that the company will continue the business throughout the financial year and the next year. So they can carry forward this loss. The remaining loss of 150,000, 100,000, which is not claimed by company A in year 1, can be claimed in subsequent year from company B. Next slide. Now, this is about the tax loss and the relief which the company can get. The losses are, these losses can be only claimed from the year where the corporate tax has been implemented. So the corporate tax has been implemented for a company from 2024, as the financial is from January to December. So the losses which has been derived in the 2024 can be only claimed as a carry forward loss. They cannot do a claim of 2023 or 22 because during that year, the corporate tax was not implemented. So only the period from which the corporate tax has been implemented, they can claim as a carry forward. And the maximum amount of carry forward is up to 75% of the taxable income of the subsequent year. So they cannot claim 100% immediately the next year, but up to 75%. But the benefit is like they can carry forward this loss until unlimited year. So the period has not been set off like they can carry for 1 or 2 years. It can be carried forward till the time the business is existing. So, and then no relief in case, yes, it is if any income prior to that, prior to the effect of corporate tax, and from the asset and activity of income which is exempt, because the income which is not taxable, you cannot claim a set off against that. Yeah, next slide. So this is an example where in 2024, if you see there is a loss of 225,000, which is being carried forward to 2025. And then if there was an income of 100,000, out of which only 75% can be claimed, which is 75,000. So out of 225,000 of 24, only 70,000 is claimed. The balance remaining is 150,000. So the net income of 2025 is 25,000. And 2026, if you see the income is taxable income is 100,000, 1 million. So out of 1 million, the 75% is the limit of previous carry forward losses to be adjusted, which is 750,000. But we only had 150,000 carry forward. So we adjust 150,000 from the previous year up to 2025. So the taxable income balance remaining is 850,000. So on this 850,000 on 2026, tax will be paid after getting the exemption minimum limit of 375,000. Yeah, and this losses can be carried forward until unlimited years. Yeah, thank you. Balram, now I hand over to Balram back.
Yeah, thank you, Manish, for taking us to the group and then tax loss reliefs. Now let's quickly go through the withholding tax, foreign tax credit, and free zone entity related rules. I know we are running out of the time, but let me just quickly cover through this. Withholding tax is specific to the transaction that you do with the entities outside UAE. And the similar rules will be applicable for the businesses that are doing business. Non-resident persons are doing business with UAE entities. So if those non-resident persons are not taxable in UAE, the UAE entities are expected to deduct some amount of tax and pay the balance to the non-resident person for the business they do with us. So at the moment, this withholding tax rate is 0%. But if I have to give an example, let's say that you are doing business with a company in Oman. You are providing some service to a company in Oman. Generally, the Oman businesses, if the transaction value is, let's say, 100,000, they deduct whatever withholding tax rate that is applicable in Oman. Let's say it is 10%. So out of 100,000, 10%, which comes to 10,000, will be deducted by the Oman company. So you'll be paid only 90,000. So this 10,000, what is deducted by Oman company is called as withholding tax, and that amount will be paid to the government in Oman. So this will be the case even for us also once the UAE tax law comes into effect. But against the 10% of the rate here in UAE at the moment, it's only 0% mentioned as withholding tax to be deducted. So which means if any outside company is doing business with you, you are supposed to deduct some tax towards withholding tax. That is at 0% now. So you will be paying full amount even after considering this withholding tax amount. But in future, if the UAE government comes out with any rate which is more than 0%, maybe 5% or 10%, then you will be expected to deduct that much amount of the tax from the transaction value and pay only net amount to outside UAE or non-resident person for the business. And this amount which is deducted will be paid to government through our returns. So this is called a withholding tax. So withholding tax credit can also be claimed only if the tax is being paid. But for now, there is no tax paid yet, so we will not have any deduction of credit for the non-residents in UAE. There's another concept called foreign tax credit. In my earlier example of 100,000 transaction with Oman company, we paid some withholding tax there and we only considered net amount here. Let's say that you have a branch in Oman and that branch is paying tax there in Oman already under the corporate taxes in Oman. But since it is a branch of UAE company, so as we discussed, so that will be included as part of your UAE company business also in UAE. So you are paying tax there as well as tax here on the branch operations. So for this purpose only, whatever tax you have paid outside UAE on the branch, that will be available to adjust against the tax payable in UAE. After adjustment of that, only net amount will be paid. So whatever amount that you are eligible to adjust is called as foreign tax credit. Of course, that tax amount will be limited to 9% of the 9% rate of the relevant income. If you are paying like 20% tax on the branch in Oman, you cannot claim the entire amount of 20% of tax paid. It will be limited to 9% tax or 9% rate only, and only that amount can be claimed or adjusted against tax payable in UAE. Because the corporate tax applicable in UAE at the moment is max 9%. So yeah, this is with respect to the foreign tax credit. Let's quickly run through one example. Let's say that you have a revenue of 3 million and deductible expenses of 2.2 million. Accordingly, your taxable income is coming to 800,000. On 800,000, the tax payable amount is going to be, let's say, 38,250. How did we calculate this? It is 9% on the taxable income in excess of 375,000. Means 800,000 minus 375,000 gives us 425,000. So 9% on 425,000 comes to 38,250. Let's say that you have paid a foreign tax amount of 5%. So now this 10,000 which is paid as a foreign tax can be adjusted against this 38,250 tax payable, and you will be paying a net tax amount of only 28,250 because you already paid tax outside on this relevant income. So that will be given as a credit, and you will be paying net amount after deducting the tax paid. So let's look at the qualifying free zone entity and how the tax rates will be applicable on them or tax will be levied on those operations. Any free zone company to be considered as a qualifying free zone person, they need to comply with these 5 conditions. So what are the free zone persons? Any free zone entity which is registered in any free zones in UAE is generally called as free zone person. So subject to meeting these 5 conditions, they will get the benefit of the specific rates given for the free zone companies. What are the conditions? The primary and important condition is that they need to maintain adequate substance in the state. So which means the free zone company should have enough amount of assets, employees being operating from the free zone. They need to have the management taking decision from a particular free zone. They need to incur the expenses, operating expenses in that free zone to match to the size of the business that they are showing in the free zone. As I mentioned earlier, if a free zone company is claiming 100 million as their turnover in a particular free zone, they need to show that they have enough amount of employees, asset base, operating expenses incurred, and management sitting here to match up to the size of that 100 million business. That's when you are considered as maintaining adequate substance in the state. So this is first condition. Second condition is that that particular free zone company should be deriving qualifying income. So what is qualifying income? This is not being defined by the law. So we are awaiting for that. So any income that you have under that particular free zone, if it is falling in the definition of qualifying income, then you will be considered as qualifying free zone. Therefore, you will get a benefit of 0% tax on your profits. Third point is that you have not elected to be subject to corporate taxes in full. So which means, though you are a free zone company, you have a choice to select yourself to be considered as a normal mainland entity, and you can ask the FTA to levy full tax as we do for mainland entities, though it is a free zone company. So that can be elected on an application made. So to qualify as a qualifying free zone person, so you should not be selecting that option. That is the third point. And fourth point is that you should comply with the arm's length pricing principles, and you should be maintaining the transfer pricing documentation. So we will look at this particular point in our later slides. But this talks about the transaction that you do with your related parties or connected persons. So if you have those transactions and arrangements, so you need to maintain that particular documentation to show that the transactions are dealt at a market rate. You're not trying to manipulate the business transactions by having transactions with related parties in order to reduce or minimize tax. So if you have these arrangements, you have to make sure that you're complying with the documentation requirement for those transactions. So this is the fourth condition. If FTA comes up with any other conditions to be complied with, so that is what is the fifth condition to comply if you have to qualify as a qualifying free zone person. So once you qualify, or once you comply with all these 5 conditions, you will be considered as a qualifying free zone person. Then you will get a benefit of 0% tax. So this we have already seen earlier that corporate tax on qualifying free zones is levied at 0% on their qualifying income. So here when I say qualifying income, it is not the revenue or turnover, but it is the profit that is coming from a specific business. So what is a specific business or activities? That is what FTA or Ministry of Finance has to tell us or clarify or give us a proper further cabinet decision. So once we get that definition of qualifying income, then we can decide what will be subject to a 0% tax, and any other income which is falling under non-qualifying income will be subject to 9%. So the qualifying free zone person's income will be classified into qualifying income and non-qualifying income. Qualifying income will have 0% tax. Non-qualifying income will have 9% tax on them. Yeah, one thing that you need to consider or be careful about is if you have a non-qualifying income. In the case of mainland entities, you have 375,000 limit, like up to a taxable profit up to 375,000 is taxed at 0%. In excess of that is taxed at 9%. Unlike mainland entity, in the case of free zone, if we have a non-qualifying income, the entire amount or entire profit relating to non-qualifying income will be subject to tax at 9% without considering that 375,000 base. Okay. There is another concept or relief given to small businesses. This is linked to the revenue of the company. What is that revenue? That is not mentioned in the decree law yet. We are awaiting for the further rules with respect to this. If any business has revenue less than that particular amount mentioned, and if that particular business wants to go for this relief, they can opt for it, upon which they will not be subject to tax for that particular year. But if you're selected or opted to be considered as a small business for corporate tax purpose, you will not be subject to tax. At the same time, you will not get the various benefits that are available, like exempt income, qualifying group relief. Means you cannot be part of a group, or you cannot adjust the losses of another entity in the group, which we have seen earlier. You will not be able to get any deductions of your expenses, and you cannot carry forward and adjust previous year losses and so forth. So these are the few benefits that you'll be losing out if you select yourself to be considered as small business relief. But the advantage is that you will not be subject to tax at all in that year. So let's quickly look at what are the takeaways out of these slides which we went through previously. So far, whatever tax we have been paying outside UAE, whether we were maintaining the tax paid on a separate ledger or not, but now we have to maintain or record those transactions properly. The reason being that you can adjust the withholding tax paid outside against the tax payable in UAE and then pay net amount. One plus is that so far whatever withholding tax paid outside UAE was becoming expense for you, but now it becomes an adjustable amount against your tax payable amount. Records relating to foreign entities, branches should be maintained properly, because you will have to adjust the tax paid outside UAE against the tax payable here. And you also need to look at the cost benefit analysis whenever you are trying to incorporate a company in free zone. Is it beneficial to incorporate business in free zone or mainland? Or which part of your business should be routed through free zone entities and which other should be routed through mainland entities? All these things you need to look at and then plan your business accordingly, structure accordingly. Also look at the small business relief. Do you have to select for that or go for that or not? There's also a decision that you have to take. So these are the few points that you need to look at or consider, keep in your mind whenever you get into this situation. Let's quickly run through the related parties and transfer pricing documentation. What is related party? These related parties can be between natural persons and juridical persons. So person A is owning 50% or more of a company B share capital, then these two become related parties. So this person may control company B. So these two become related parties. So any individual having shares investment, which is equivalent to 50% or more of that particular company, or he is controlling the business of that particular company by taking the decisions, then these two, this natural person and that company becomes related party. It's not only between individual and company, but it could be between companies also. Company A could be owning 50% or more of company B, then these two companies become related party. Or if company A is owning shares in companies through company B, and if that total amount becomes 50% or more of company A, company C share capital. In this way, means directly or indirectly through some of the subsidiaries, if companies are owning 50% or more of the other companies, then these companies become related parties. It is obvious that you have interest, so you have a control or an interest to regulate the business of those other related parties. So in that process, you can also manipulate the rates that you levy or charge for the transactions that you have with the related parties. What kind of transactions you could see between these related parties, which could come under this transfer pricing documentation, which we need to be careful about. Any services that are being provided between these related parties who are connected. Some things like IT, ITS, sales, marketing. So any kind of services, if they are happening, so they will be considered as transactions with related parties. Not only services, goods also. If the companies which are related, if they are doing any transaction between them, so all those transactions like purchase of goods, sale of goods, and so on, they will be considered as related party transactions. Utilization or usage of tangible properties. Company A may be having the asset, but company B, which is related party, may be using this particular asset for the business. So all these transactions and arrangements will fall under this related party transactions. Financing arrangements, intra-company rules or intra-group loans, all this will come under this. Intellectual properties, royalty, licensing fees paid between these related parties will come under this transfer pricing or related party transactions. Capital transactions, of course, they'll come under this. Any intra-group services, cost contribution arrangements, business restructuring, reorganizations between the group entities, if they are not becoming a tax group. Any domestic transaction between mainland business with free zone persons, if they are related, so they will fall under this category. And transaction with connected persons, which we'll look at later. So all these transactions will fall under related party transactions, and they need to comply with specific documentation, which we'll look at later. Not only related parties, there is a concept called connected persons. So far, we have seen arrangement with individual to a company, like in the form of shareholding or between companies. This is with respect to individuals with the company, but not for business. Like owners. Owner of a company is considered as a connected person for the company. Not only owner, a director of the company, an officer who is an influential or responsible position in the company, they are also considered as connected persons for the company. Not only them, but the relatives of owner, director, or officer are also considered as connected persons for that particular company. So needless to say that if the company is getting into any transaction or arrangement with these connected persons, like owner or director or officer, they will be considered as related party transactions, and they should be looked at carefully. These are the few transactions that we can consider as. Now, when we say this relatives of the owner, director, and officer, so at what grade or kinship of relationship be considered as related persons? So they said that not only the individual and the immediate family, but they say that 4 generations above and 4 generations below. 4th degree kinship is what is mentioned as related parties. for that particular individual for the connected person's definition. So means your parents, grandparents, great-grandparents, and great-great-grandparents. All these will become related party for you. So is the case with your children, grandchildren, great-grandchildren, and great-grandchildren. So the companies now should be careful, like, they need to maintain a list of individuals who fall under this category. And if the company is doing any transactions with them, which any of them, they need to be careful that the prices that are being levied on those transactions are at arm's length. So most of the times we see this kind of transactions in our books of accounts. If you are paying any salary to the owner as a company, if the company is paying salary to the owner or a remuneration or any other similar nature of payment, they will be considered as transactions with connected persons. And you need to make sure that that is benchmarked and shown as an arm's length price. So for example, you're paying salary to our owner, company is paying salary to our owner, monthly, let's say 200,000 dirhams. But if you look at the service that owner is providing to the company, the same service is provided by a third party person. So you may not be paying 200,000 salary per month, but you may pay, let's say 30,000 dirhams as a salary per month if it is a third party. So this is what should be considered as a benchmark or arm's length pricing. So from 200,000, that entire amount of 200,000 which is paid as salary will not be allowed to be deducted from your revenue to compute taxes. You will be limited only to this 30,000 and the excess amount will be added back. So it means you can only show 30,000 as salary for your owner and the remaining balance should be added back. So that's what is the important thing that to consider now. Not only that, if the company is paying any rent to the owner or any other perquisites are given, or the company is paying interest on the loan given by the owner, director or officer, all those should be looked at and make sure that they are charged at market price. So you have various things to consider and we need to be careful for all these transactions to make adjustments. So now let's look at the last leg of the presentation, CT Administration. Registration is required for all the companies. There is no minimum threshold mentioned, and you have to get yourself registered before submission of the corporate tax returns, which means you have enough amount of time. And this registration can be done electronically online. How frequently and what are the rules with respect to tax returns filing? One tax return will be filed for the entire year per company or per group. Corporate tax will be filed, a return will be filed within 9 months from the end of the financial year. And there is no advance tax to be paid. It will be paid only after the end of the financial year. In some countries, they have quarterly filings to be done and they have to pay advance tax on quarterly basis. But in case of UAE, there's nothing like that. It will be 1 year or yearly tax return to be filed and tax will be paid within 9 months from the end of the financial year once. This is how you generally compute the taxes. And this is the generic form that we can see for corporate tax returns. So these are the various points that we already went through. So how computation will be done. So this is how it is being done. How many years do we have to maintain the books of accounts and keep the records? They say it is 8 years, 7 years after the end of the financial year, which means fully 8 years you have to maintain the records. In VAT case, we had 5 years as a minimum period to keep the records. Now for corporate tax purpose, you have to keep the records for 8 years. Anytime during this period, the FTA can come back and ask you questions with respect to them. Who all should maintain the records? Every taxable person should maintain the books of accounts. And the transitional rules, whenever the corporate tax is applicable for you for the first time, so the opening balances should be kept as if the corporate tax law was applicable to them, even for the first opening balances also. So which means if you have a corporate tax applicability from 2024 onwards, you need to make sure that 22-23 books are also maintained in such a way that the corporate tax is applicable. When we get into 2024, you have to go with the books of accounts which are full in compliance with corporate taxes. All your assets, all your liabilities, all your opening balances which are carried forward should be reviewed, and you should make sure that they are presented at the appropriate amount. If you have any over accrued expenses or accruals or provisions, you need to make sure that they are brought down to the right amount. So is the case with your asset values. There are specific rules given for your assets in the law. So you need to make sure that you're complying with 2023 books from the point of view of corporate tax to be able to go to 24 with a clean records. There is a specific rule which is called as general anti-abusive rule. So this is a particular rule which is given in order to avoid any abusive transactions or arrangements made in order to reduce the tax. Now the law is already been implemented, in the sense is enacted. So any arrangement that you make now or any transaction that you enter into now with a purpose or motive of reducing tax in future or minimizing a corporate tax in future, then these transactions or arrangements will be carefully looked at by FTA to see whether this is being done with a pure or sole objective of avoiding tax. You did this transaction or arrangement with a commercial reason, then it is fine for FTA. But if you do this change in the ownership structure or you are changing this business structure and all those things, if you're doing now, the FTA will be vigilant on those arrangements and transactions. If they are entered only with an objective of avoiding tax, then FTA may ask you to reverse this effort and pay tax in full amount. So this is the reason why whenever you do any tax planning from now onwards, you need to be careful and have the supporting document or documentation in place to make sure that it is not falling within this rule. Be prepared for compliance. There's a quote which says that by failing to prepare, you are indeed preparing to fail. So if you're not prepared for corporate tax compliance or implementation now, you are heading towards preparing to fail. So it's always important to comply with it and prepare in advance. How the preparation can be done? High-level impact assessment can be done by looking at your structure of the organization and the group. Detailed analysis can be done after coming up with this high-level bias. And the corporate tax can be implemented once the other rules also be released. And then once the implementation is done, post-implementation, what are the adjustments can be done? So this is how we can, if you want us to analyze and implement the corporate tax, can be done by us. What are the important areas to be looked at? Most of them we've already looked at it. Look at the structure of the group and organization and make sure that that is in line with the corporate tax and you are getting maximum benefit out of that without avoiding any rules or not without breaching any rules. If you have any related parties, the connected persons, you make sure that you comply with all this. We have seen all these documentation requirement and all. So you need to make sure that you have it in place. This particular area, the related party and connected persons, if you have entities outside UAE, it is going to play a vital role. And the documentation requirements are huge, and you need to make sure that you're complying with that. We can provide services on this also. We have a specialized team on this transfer pricing. If any of you has got requirement for this. You need to look at the cash flow arrangements, profitability, and all those things you need to look at. In the books of accounts also, what are the changes that are required to comply with or to be ready with the compliance of corporate tax. The main thing is that you need to look at your chart of accounts. See, make sure that you have enough ledgers or accounts being maintained to be able to fit in the requirement of corporate tax, so that when you look at the books of accounts at the end of the year, you have clear records, clear accounts. Wherever you require or you need to make adjustments to be able to file the corporate tax, you should be able to provide that results. So that's why careful observation of the transaction, chart of accounts, and transaction entry by the accounts team should be looked at and plan it so well that at the end of the year, you do not have any issues of looking back, reviewing the transactions, and then spending additional time and efforts. So to be able to comply with it easily, so you prepare from now onwards. Most of the group entities or groups, they're actually conducting mock corporate taxes now for 2021, 2022, and 23. As if the corporate tax is applicable to them, what would be the effect and what are the changes that we need to look at for the previous years? Once you know all these, so preparing for future becomes easy. So this can also be done by us if you want. So various deduction limits are there, so you need to look at them. What will be applicable to you, what will not be applicable to you, and your systems also you need to relook at them. Whether your system is capable enough to handle the requirements or changes that are required for compliance. If you have any businesses outside UAE, so non-resident companies are there, so you need to look at the taxability of them in UAE itself. You review your legal transactions, legal documents and contracts with your customers, with your suppliers, and make sure that they are in line. If you have a team of accountants or finance team, so make sure that you have training and they're also aware of the changes that are expected while entering the transactions and taking decisions. So these are the few things that you need to look at to be able to prepare and be ready to implement the corporate taxes. So this is what it is with respect to the corporate tax, which is mentioned in the law and FAQs. And we believe that we provided the information that is required and we made some value addition to your understanding of corporate taxes. I know we are done with our time. We will look at the messages that are left in the message box. But if any of you has got any other questions, or if you need any other support service with respect to corporate tax or transfer pricing, or if you require any training to your team, you can drop your email to the email ID given here, info@spectrumaccounts.com. So we will definitely get back to you. And if any of you require the presentation, also let us know in this mail or drop us an email to this particular mail ID. So we'll send you the corporate tax presentation that we presented here. Thank you all for attending the session. But if there are any specific questions that if you can address now, we are ready to address them. Raghu, I think we may have to unmute all just in case if they have any questions. And meanwhile, Pratiksha, can you look at the questions or comments in the chat box if there are any questions mentioned?
Sure. So, so we have one question relating to taxability of free zone companies. I think this was dropped before explaining the taxability of free zone companies explanation in our PPT.
Yeah.
And it's just that this presentation will be available on our YouTube channel, and it will also be available on our blog section on our website.
Yeah. All right.
So I think there's no other question given by anyone.
Great. So I think, so as I mentioned, so if you have any specific question, you can just drop an email to this mail ID, info@spectrumaccounts.com, or give us a call. So we'll try to respond to that. So once again, thank you each and everyone who participated in this, and also thank you to Manish and Pratiksha. Thank you all. Have a good day.